Hello everyone, welcome to EPK Capital's deep dive video. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Intuit. For millions of individuals and small business owners across the United States, the annual rituals of finance, filing taxes, managing payroll, balancing the books, are inextricably linked to a single corporate entity, Intuit Inc. The company's products are not merely software applications, they have become a foundational operating system for a significant portion of the American economy, serving approximately 100 million customers worldwide through flagship brands like TurboTax, QuickBooks, Credit Karma, and MailChimp. This deep integration into the financial lives of its users has transformed Intuit into a technology powerhouse with a formidable business model and a history of impressive financial performance. However, this market dominance exists in a state of tension. The company's premium valuation reflects immense investor confidence in its future, a future it is building around a sophisticated, AI-driven platform. Yet, this very success has drawn intense scrutiny. Intuit faces persistent questions about its competitive practices, significant regulatory headwinds, and the ethical implications of its powerful lobbying efforts. This analysis seeks to provide a comprehensive, 360-degree view of Intuit. It will explore the company's journey from a simple idea to a global platform, conduct a deep dive into a decade of its financial results, analyze its stock chart's long-term narrative, and apply classic valuation metrics to its current price. Furthermore, it will present a balanced debate between the bullish and bearish investment theses and examine the major controversies that are critical for any potential investor to understand. The result is a portrait of a financial juggernaut at a crossroads, where its greatest strengths and its most significant risks are intrinsically intertwined. The Intuit story, from a kitchen table to a global AI platform, the founder's vision. The origins of Intuit trace back to a moment of common frustration. In 1983, at his kitchen table in Palo Alto, California, Scott Cook watched his wife struggle with the tedious task of balancing their family checkbook by hand. A former Procter & Gamble employee, Cook recognized that the burgeoning personal computer could offer a better way. This simple insight, that technology could solve the most important and often frustrating financial problems for consumers, became the founding mission of Intuit. Teaming up with co-founder Tom Proles, a programmer at Stanford University, they created Quicken, a revolutionary software that simplified personal finance management and laid the groundwork for a company that would grow to define its industry. A history of strategic transformation. Intuit's 4-decade history is a case study in strategic adaptation and aggressive expansion. The company successfully navigated multiple technological shifts, evolving from a DOS-based software provider to a dominant force on the web, in mobile, on the cloud, and now, in the era of artificial intelligence. This evolution was fueled by a series of transformative acquisitions and calculated divestitures that continuously reshaped its business focus. The company's empire was built through strategic purchases. The acquisition of Chipsoft in 1993 marked its entry into the lucrative tax preparation market, which would become the foundation for TurboTax. In 1998, it acquired Lassite Software Corp., cementing its position in the professional accountant market, and a year later, it bought Computing Resources Inc. to integrate payroll processing directly into its QuickBooks platform. More recently, a new wave of acquisitions has redefined the company's scope, moving it beyond pure software into a connected ecosystem of financial data and services. The 2009 purchase of Mint.com expanded its personal finance offerings. The landmark acquisitions of Credit Karma in 2021 and MailChimp in 2021 were pivotal, bringing in massive user bases and invaluable datasets on consumer credit behavior and small business marketing funnels, respectively. These moves were not just about adding products but about acquiring entire ecosystems and the data needed to fuel the company's next-generation AI platform. Concurrently, Intuit has shown strategic discipline by divesting non-core assets, such as selling Quicken Loans back to its founder and spinning off its real estate solutions division, allowing it to reallocate capital and focus on its primary growth objectives. Leadership and ownership. Today, Intuit is led by CEO Shashank Godazi, who took the helm in 2019 after a long tenure leading the company's two largest divisions, the Consumer Group and the Small Business Group. His leadership, supported by a deep executive bench including CFO Sandeep Aujla and STO Alex Balazs, represents internal continuity and a profound understanding of the company's core products and long-term strategy. The company's ownership structure reflects its status as a mature, blue-chip technology firm. While founder Scott Cook maintains a meaningful position with approximately 2.4% of the company's shares, Intuit is predominantly owned by some of the world's largest institutional investors. The top 3 shareholders are passive investing giants, the Vanguard Group, holding approximately 9.9%, BlackRock, approximately 5.5%, and State Street Corp, approximately 4.6%. This heavy ownership by index funds provides a stable and consistent source of demand for the stock, as these funds must purchase shares based on the company's weighing in major indices like the S&P 500 and Nasdaq 100. This dynamic creates a supportive flow for the stock price but also contributes to a valuation that is less sensitive to short-term price fluctuations, as a significant portion of buying activity is not based on discretionary value assessments. Decoding the financials, a decade of dominant growth. A decade of Intuit's financial statements tells a clear story of consistent, powerful growth and high profitability. The company has successfully scaled its operations, expanded its revenue streams, and delivered robust returns to shareholders. Revenue trajectory and segment performance. Over the past decade, Intuit's revenue has demonstrated a powerful and consistent upward trend, growing from approximately $4.2 billion in fiscal 2015 to over $16 billion in fiscal 2024, with some sources showing a trailing 12-month figure approaching $19 billion. This represents a compound annual growth rate that is highly attractive for a company of its scale. This growth is powered by several distinct business segments, each with its own dynamics. The Small Business and Self-Employed Group, recently renamed the Global Business Solutions Group, is the company's largest and fastest-growing segment. It is anchored by the QuickBooks ecosystem, which includes accounting software, payroll services, payment processing, and now marketing automation through MailChimp. This segment grew an impressive 19% in fiscal 2024, driven by strong performance in its online offerings. The Consumer Group is dominated by the highly seasonal but extremely profitable TurboTax franchise. While its overall growth is more moderate, 7% in fiscal 2024, a key driver within this segment is TurboTax Live, the company's assisted tax preparation service. Revenue from TurboTax Live surged 17% in fiscal 2024, indicating a successful strategic shift towards higher value, service-oriented products. This move allows Intuit to capture customers who desire professional assistance, effectively competing with traditional accountants and defending against the potential commoditization of simple, do-it-yourself tax returns. The Credit Karma segment, added in 2021, has become a significant contributor, providing a platform for consumers to manage their credit and find financial products. It generated $1.7 billion in revenue in fiscal 2024, growing 5% year-over-year. Profitability and margin analysis. Intuit's strong revenue growth has translated effectively to the bottom line. Net income has expanded from $365 million in 2015 to $2.96 billion in 2024, a more than eightfold increase. 0.15 This profitability is underpinned by the company's exceptional margin profile, which speaks to its significant pricing power and efficient, scalable software-based business model. The company consistently maintains a high gross margin, typically ranging from 77% to 82%. This indicates that the cost of delivering its software and services is very low relative to the price customers are willing to pay. Furthermore, its operating margin has remained robust, consistently staying above 20% and often approaching 30%. 0.16 This demonstrates strong control over operational expenses like research and development, sales, and marketing. Consequently, the net profit margin is also healthy, generally landing in the high teen to low 20% range, showcasing the company's ability to convert revenue into actual profit for shareholders. Balance sheet integrity. An examination of Intuit's balance sheet reveals a strategic shift in its capital structure over the past decade. For many years, the company operated with a relatively low level of debt. However, the large-scale acquisitions of Credit Karma and MailChimp were financed, in part, by taking on significant leverage. As of the end of fiscal 2024, the company reported total debt of approximately $6 billion against a cash and investments balance of $4.1 billion. This has caused the debt-to-equity ratio to rise from its historical lows to a more moderate level, fluctuating between 0.3 and 0.74 in recent periods. While these debt levels are not alarming for a highly profitable company with strong cash flow, they do introduce a new element of financial risk. The success of these major acquisitions is now critical not only for driving future growth but also for servicing the debt used to finance them. Should the expected synergies and revenue growth from these new segments fail to fully materialize, as evidenced by some of the noted underperformance in the MailChimp business, the debt burden could limit the company's financial flexibility in the future. A value investor's lens, the Benjamin Graham valuation. To assess Intuit from a classic value investing perspective, we can apply two formulas developed by Benjamin Graham, the mentor of Warren Buffett and the father of value investing. It is crucial, however, to understand the context and limitations of these models, especially when applied to a modern technology company. Applying the Graham intrinsic value formula. Graham later revised his formula for valuing growth stocks to account for prevailing interest rates. The formula is intended to estimate a company's intrinsic value over the next 7 to 10 years. Compared to a market price of approximately $680, this formula suggests that Intuit stock is significantly overvalued from a traditional Graham growth perspective. The Graham number, a defensive check. For more conservative, defensive investors, Graham proposed a simpler formula known as the Graham number, which establishes a theoretical upper limit one should pay for a stock. The formula is, Graham number equals 22.5 times APES times BVPS. Plugging in the values, Graham number equals 22.5 times 13.67 times 70.61. Graham number equals 21731.5 approximately equals $147.42. This far more conservative metric suggests that Intuit is dramatically overvalued, with its market price trading at more than 4 times its Graham number. Interpretation and context. The stark divergence between Intuit's market price and its valuation under Graham's formulas is not necessarily an indictment of the company, but rather a reflection of a fundamental clash between two different investment philosophies. Graham's framework was developed in an industrial era and places a heavy emphasis on tangible assets, captured in book value, and conservative earnings multiples. Intuit, as a modern software company, derives its value primarily from intangible assets that are not fully reflected on its balance sheet. Its powerful brand recognition, its vast and proprietary customer dataset, high customer switching costs, and the network effects of its platform. The market is pricing the stock based on the future potential of these intangible assets, particularly the ability to monetize them through AI and data analytics, factors that Graham's asset-focused formulas are inherently ill-equipped to measure. Therefore, while the Graham valuation provides a sobering check on the stock's current price, it also highlights the degree to which investors are betting on a future that looks very different from the past. The investment thesis, the bull versus bear debate. The bull case, the path to further growth. The optimistic outlook for Intuit is built on three core pillars: its entrenched market position, its aggressive push into artificial intelligence, and its expansion into new, lucrative markets. 1. Unassailable market leadership and brand moat. Intuit enjoys a near monopolistic position in its key US markets. QuickBooks commands an estimated 80% share of the small business accounting software market, while TurboTax holds a 70% share among those who file their taxes without professional help. This dominance creates a powerful competitive moat, reinforced by strong brand loyalty and high switching costs for customers who have built their financial workflows around these platforms. 2. The AI-first transformation. Intuit is strategically transforming itself into an AI-driven expert platform. It is embedding generative AI across its entire product suite with tools like Intuit Assist and its underlying Genos platform. This strategy aims to automate complex tasks, deliver personalized financial insights, and increase operational efficiency. The company's unique and massive dataset, spanning decades of tax filings and small business operations, provides a formidable, proprietary advantage in training its AI models, which competitors cannot easily replicate. 3. The untapped mid-market opportunity. Historically focused on individuals and small businesses, Intuit is now making a concerted push into the mid-market with its Intuit Enterprise Suite. This segment represents a massive $89 billion total addressable market, TAM. With an existing base of 800,000 QuickBooks Online users who already fit the mid-market profile, Intuit has a clear and natural upsell path to convert these customers to its more comprehensive and higher-priced enterprise offerings. The bear case, the headwinds and hurdles. Conversely, the pessimistic view highlights concerns around the stock's rich valuation, the ever-present threat of competition, and a uniquely significant regulatory risk. 1. Premium valuation and high expectations. Intuit stock consistently trades at a premium valuation. Its P/E ratio often sits in the 50-60 range, and its price-to-sales ratio is around 10, both of which are high relative to the broader market and even its industry peers. This elevated valuation suggests that years of strong growth are already priced into the stock, leaving very little margin for error. Any operational misstep or failure to meet ambitious growth targets could lead to a significant price correction. 2. The threat of disruption and competition. While dominant, Intuit is not without challenges. It faces intense competition from established players like H&M, R-Block, Sage, and Xero, as well as a host of nimble, venture-backed fintech startups that often offer lower-priced or free alternatives. The acknowledged underperformance of the MailChimp segment, which faces its own set of strong competitors, demonstrates that even Intuit is vulnerable to competitive pressures, particularly in markets outside its core accounting and tax franchises. 3. Significant regulatory and political risk. The single greatest threat to Intuit's business model is the prospect of the US government creating a direct, free tax filing system. This is not a hypothetical risk. The IRS has already launched a pilot program called Direct File. Intuit has spent tens of millions of dollars over 2 decades lobbying aggressively against such a government-run alternative, as it would represent an existential threat to its highly profitable TurboTax business, which accounts for nearly 30% of total company revenue. The political and regulatory pressure on this front is substantial and ongoing. Ultimately, the central tension in the Intuit investment case lies in the relationship between its greatest strength and its greatest risk. The company's massive dataset and market dominance are the fuel for its powerful AI-driven bull case. However, it is precisely this dominance over a critical civic function, tax filing, that attracts the intense regulatory scrutiny that forms the core of the bear case. The more successful Intuit becomes at leveraging its data to lock in customers, the stronger the political argument becomes for a government-led alternative. Due diligence, controversies and global standing. The Free File saga and lobbying efforts. Intuit's most significant public controversy revolves around its marketing of TurboTax and its participation in the IRS Free File program. A series of investigative reports by ProPublica brought to light that Intuit was using deceptive marketing tactics and dark patterns in its web design to actively steer taxpayers who were eligible to file for free through the government-partnered program toward its own paid commercial products. These revelations sparked widespread public outrage and led to investigations by multiple state attorneys general and the Federal Trade Commission (FTC). The culmination of these investigations was a major settlement in May 2022, in which Intuit agreed to pay $141 million in restitution to more than 4.4 million customers across all 50 states who were tricked into paying for tax preparation services that they should have received for free. While the company admitted no wrongdoing in the settlement, it has since withdrawn from the IRS Free File Alliance. This issue remains a significant reputational and business risk. The controversy has provided political ammunition for lawmakers who advocate for a government-run tax filing system. Intuit continues to spend millions of dollars annually lobbying against the IRS's Direct File program, arguing that it is unnecessary and inefficient. For investors, this ongoing battle represents not only a tangible operational expense in the form of lobbying costs but also a major ESG, environmental, social, and governance concern related to the company's business ethics and its influence on public policy. Global market position and challenges. Despite its global branding, Intuit remains heavily dependent on the North American market. Total international net revenue consistently accounts for only about 8% of the company's consolidated total revenue. 0.54. This highlights both a significant opportunity for future growth and a current challenge in execution. While QuickBooks is the undisputed leader in the US, its competitive moat is considerably shallower abroad. In markets like Canada, its market share is a solid but not dominant 47%. In Australia and New Zealand, it holds only a 9% share, trailing far behind local champion Xero, which commands 56% of the market. This demonstrates that the network effects and brand recognition that protect its US business have not been easily replicated overseas. Expanding its international footprint against entrenched local competitors remains one of the company's most significant long-term challenges. Conclusion: a synthesized outlook. Intuit Inc. presents a compelling but complex picture for investors. It is, in many ways, a tale of two companies. On one side stands a financial and operational juggernaut. It possesses a fortress-like competitive moat in its core US markets, a track record of remarkably consistent revenue and profit growth, and a clear, compelling vision for its future as an AI-first platform. Its ability to generate substantial cash flow and maintain high profit margins is a testament to its operational excellence and the pricing power of its indispensable products. On the other side, however, is a company that carries notable risks. Its stock trades at a premium valuation that demands near flawless execution and leaves little room for disappointment. It operates in a dynamic industry with constant threats from both established competitors and disruptive newcomers. Most critically, it faces a significant and persistent cloud of regulatory and reputational risk stemming directly from its business practices and aggressive lobbying in the tax preparation space. The potential for a government-backed free file system remains the single largest threat to a core part of its business. Therefore, a potential investor must carefully weigh Intuit's undeniable strengths, its market dominance, profitability, and innovative potential, against the very real risks posed by its high valuation and the political headwinds it continues to navigate. The future trajectory of Intuit's stock will likely be determined by a single, overarching question: can its technological innovation, particularly in artificial intelligence, continue to outpace the formidable threats from regulators and competitors? Disclaimer: this report is for informational and educational purposes only and should not be construed as financial or investment advice. The analysis is based on publicly available information and is not a recommendation to buy, sell, or hold any security. All investment decisions involve risk, and individuals should conduct their own due diligence and consult with a licensed financial professional before making any investment decisions. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.